we're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured. No worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So and that was it. Well, that's when I call the billionaire crybabies came out in force. Bill Ackman, all these guys. Oh, you got to save us. I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people say, almost nobody knew at the time except the management, although they seem to be asleep at the switch. Everyone's like, yeah, startups, venture capital. There's a lot of truth to that. 97% of the deposits of Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much of this is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were, by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses, and by the way, we are in an election cycle here in the United States, but from the greenies who are extremely powerful. So that was Friday night. So Saturday, everyone's crying to the White House. Sunday night is 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. And then the week after that was something else. But they always announce the collapse on Friday and they announce the relief on Sunday. So they have the weekend to work on it. But you got to be careful about 3-day weekends. Easter, Easter is an example. But so on 6 o'clock on Sunday, March 12th, 48 hours after the FDIC announcement, the government said, just kidding, the deposits are fine. They did a complete 180 under pressure from the Fed, the White House, et cetera. Even though FDIC did the right thing, legally, they said all the deposits are good, all of them, including my friend's $8 billion and somebody else's $3 billion, et cetera. And then they went further, and this is what I meant, Brian, by the biggest bailout in history. Jay Powell said to every member bank, not Silicon Valley, but every member of the Federal Reserve System, if you have underwater bonds, U.S. government securities, treasuries or certain mortgages, you can ship them to us. We will give you a loan at par value. We'll give you cash equal to par value, even though the loans are only worth 80 to 85 cents on the dollar, because interest rates have been going up for over a year. The value of the bonds goes down. That's bond math 101. Rates up, bonds down, prices down. Rates go down, the prices go up. Well, the rates have been going up, so the prices are down. So these bonds are worth 80, 85 cents on the dollar. But here's the Fed saying, we'll give you 100 cents on the dollar for your 85-cent bond on a 1-year loan. So the loan was important because it means they didn't actually sell them. It was collateral for a loan, except you're under collateralized. And the Fed's like, okay. I said, I have a 14-year-old car that my dealer says he won't give me any money for. So I sent a tweet out. I said, hey, Fed, would you give me the $70,000 I paid for it? It's not worth anything, but let's get back to par here. That's what the Fed was doing for the entire system. But the thing is, Brian, you're talking about multiple trillions of dollars of bonds that fit that description I just gave you. Now, the banks are kind of saying, oh, that's good. That's a good deal. I'll take that. I'll do that myself. Here's something under collateralized. You give me the cash on a 1-year low interest rate loan. And now in theory, I've got all the cash I need to, pay depositors if they were taking the money out. But better yet, I don't have to record the loss. See, because I could sell the bonds in the market and get cash and pay my depositors. But the minute I do that, I've got to mark down my entire portfolio. And by the way, those unrealized losses, estimate probably $800 billion in the banking system as a whole. So you've got $800 billion of buried losses. And here's the Fed saying, we'll give you, 100 cents on the dollar, even though your bonds are worth 80. And you don't have to take the loss because it's structured as a loan, not a sale. So this is a multi-trillion-dollar bailout. It's legal in the barest sense, but it's an accounting game. It's a bailout game of unprecedented magnitude. And by the way, we'll get, a year from now, March 2024, they'll extend the loan. I mean, right. It's only 1 year. Yeah, exactly. Right. You're not going to be able to repay this. Who says interest rates are coming down? We'll see, but they're not going to, they're just extended. So, but this goes back to my earlier point. What else you got in your bag of tricks? I mean, you just guaranteed every deposit in the system de facto. You just guaranteed par value for, trillions of dollars of government securities that are underwater. You just told everybody they don't have to record any losses. You've just given them all the cash that your printer can print with no consequences. But then they get, what else have you got? There's nothing else they can do. And one more twist on this. Remember what the Fed's been doing for the past 14 months. They've been raising interest rates. Yeah, we know that. But they've also been reducing their balance sheet. I run to people all the time. They bang the table. Hey, the Fed's got to stop printing money. They're printing too much money. They've been burning money. They've been reducing the base money supply for over a year, about a year and a half. Well, now, okay, so the base money supply is coming down. Rates are coming up. But what does it mean if $1 trillion worth of bonds show up and the banks delivering the bonds say, give us the cash? Where does the cash come from? The Fed prints it. So now you're going to expand base money by perhaps $1 trillion or more at a time when you've been pretending to reduce base money. So this completely blows up their monetary tightening. Okay, they're not cutting interest rates. That we'll see what happens there, but they are increasing the money supply by, again, estimate upwards of $1 trillion. So what happened to your inflation fighting? What happened to your monetary tightening? And they just want to pretend. I mean, you do have to be expert to understand all these mechanics, but they're not that hard to explain. I mean, you can just say it in plain English, which is what we're doing. But from a policy point of view, it completely blows up their monetary tightening.
Just want to say that you have recorded a video where you go really deep on this, on the upcoming crash that you say is going to be fast, bloody, and unavoidable. But you also explain how people can position themselves to profit from it. Again, people can watch that video at londonreal.tv/Jim. I highly recommend everyone watch that video. It won't be available on socials. Hey, it's Brian Rose, founder of the DeFi Academy. I've told you my 4-week crypto bootcamp is amazing, but don't take my word for it. This is what my students are saying.
The DeFi Academy was an amazing experience for me. It took me totally out of my comfort zone.
In this course, I was challenged, I was held accountable, and pushed to do things that honestly weren't always easy.
It's been phenomenal, and I can't believe we're already up on our 4 weeks. It has flown by.
Going through this DeFi accelerator by far was one of the best courses I've taken.
You do this course, you really get into the nitty-gritty of the activities that will make you comfortable with decentralized finance.
Thank you so much to Brian and everyone at London Real and the DeFi Academy for even putting together an amazing course like this.
Anybody else that wants to do it, please sign up. It is well worth the money.